Welcome to today's SilverOak quarterly webinar. My name is Shannon King, and I'm President, Partner, and Chief Compliance Officer of SilverOak. And with me, as usual, is Jonathan Charlo, also a partner of the firm and our lead analyst. And I will make a special note, Jonathan, today that if I have forgotten to mention it, your designations have got a little longer.
They have, although I haven't quite caught up to you.
So. Well, you're well on your way. So I'm very pleased to announce that Jonathan is now a Chartered Alternative Investment Analyst, the CAIA, which will come in very handy today because, as everyone's going to see, we will have as one of our topics a discussion on cryptocurrencies, which I guess falls in what we might think of as potentially an alternative investment. Before we get to that, though, I want to welcome everybody again. Today's webinar is scheduled for 45 to 60 minutes in length. If you have any questions throughout the webinar, I encourage you to, after the webinar is concluded, reach out to your SilverOak advisor. If you're not working with a SilverOak advisor, you can contact me directly at 952-896-5701. And of course, I do want to thank Jonathan, you and the rest of our team who works, I know, very diligently to pull this information together in a timely fashion. So kudos goes out to everybody that's involved, both on the technical side as well as IT, and just making it happen. For compliance purposes, I must note that we will be discussing the overall markets and the economy during this webinar. In doing so, we will be providing our interpretations and perspectives. You should not rely upon this information as fact when making any investment decisions. Also, we will not be discussing specific SilverOak portfolio performance, as each of our clients' portfolios are customized. Nonetheless, all of our clients should have received their customized performance reports over the last week or two. If you have any specific questions on those, I again encourage you to reach out to your SilverOak advisor if they haven't already contacted you. And of course, since I am Chief Compliance Officer, I have a last disclosure, and that is past performance is no guarantee of future success. So let's look at the agenda. As usual, we'll start with a discussion around economic data for the quarter, and then looking forward, we'll talk about market performance. That will lead us into a discussion on our outlook as we look ahead. We'll close today's discussion talking about perspectives on cryptocurrencies and what we think about cryptocurrencies. That will be the very last topic of the day. Just prior to that, we will touch on SilverOak's updates and things that are happening or have happened here within the organization itself. All very positive. And of course, I encourage anyone attending today's session, if you do have questions or even topics that you want us to cover in future webinars, I encourage you to reach out to your SilverOak advisor. So Jonathan, we say here under economy, record-breaking rebound. So let's look at what we mean by that over the course of the next couple of slides. And we're going to start, Jonathan, with the dashboard, where we break out the data amongst four major categories: economy, credit markets, valuations, and market sentiment. And here, really, of the four, we have three that are showing green. And just to remind everybody, what does that signify?
Well, green means that things are definitely improving or are considered positive in the model. Gray is more neutral, and then red is negative. So in the case of valuation, means that it is high right now.
So as we blend these four together, we have a composite, and the composite currently is in the more than neutral category. But as we project forward, it looks like we believe it to go positive next quarter. Is that Fair?
That's correct. And on the next slide, we'll see that certainly the composite scores have continued to improve.
Sure, and that's where we're seeing these composites. As we look at those two circles, one of them is the current composite, the other is the 6-month average composite. And I guess it's important to note that both composites are well above kind of what we consider thresholds. And that threshold is more from maybe a more negative sentiment to a more positive sentiment. Anything else you want to add to that, Jonathan?
Well, the only other thing, and we didn't actually talk about this before, but you're probably aware that the National Bureau of Economic Analysis just announced this past week or so that the recession ended in April of 2020.
Yes, and it was the shortest recession in history. So it started in March and it ended in April, which I've got some interesting statistics on that. It was the shortest on history. The next shortest was 6 months in length, and that was from January to July of 1980. And just for everybody's information, the longest on record is 65 months. And that was all the way back, you might not remember it, you were just a toddler, October 1873.
Yeah, you had me going there. Okay, early 70s.
Yes, October 1873 to March of 1879. So let's hope we don't see another one of those. Let's talk about our economic factors and the scorecard. So here, Jonathan, we didn't see a lot of change from last quarter, but a few adjustments. In particular, corporate earnings did not shift categories, but the sentiment has improved. And I think we're going to touch on corporate earnings in a little bit more detail in a few slides. We'll also touch on inflation, and that actually has shifted a little bit more negative. Again, we didn't move it to negative in these categorizations, but if it continues, we may actually move it from neutral to negative in future quarters. Two categories that you did shift from negative to neutral, and those are global growth and Eurozone, which I know we are going to touch quite a bit more on as well. And I think in some of our discussions, Jonathan, you've even mentioned if things continue, that might actually go over into the positive column.
Yeah, absolutely, as well as potentially corporate earnings.
Corporate earnings.
As they progress as well.
Good point. Well, one thing that we haven't put on the factor that we don't want to go unrecognized, and that is COVID. And if we just put COVID as a categorization, it would certainly be in the positive category at this point. Cases are down 90%. Now, we understand that the Delta variant is a major concern for a lot of countries, so we don't want to discount that. But at this point, it looks like it's mostly impacting those that are unvaccinated, although it doesn't mean that those who have been vaccinated are completely immune from that. So that's something that we certainly are monitoring and aware of. So let's talk about consumer activity. What are we seeing here, Jonathan?
So we're clearly seeing that economic activity continues to recover. We showed that in March. It's continued to recover. Travel, navigation app usage, debit, credit card transactions are now above pre-pandemic levels. Now the TSA traveler data is still well below, but it is moving in the right direction.
Sure. And this is so important because consumers drive 2/3 of the US GDP. And so that's where we're going to touch a couple of times on the US consumer during today's call. So what about global momentum?
Well, we kind of hinted on the dashboard that it was improving, and that's clearly what we're seeing on this slide. It actually dipped much below where we were back in 2008, but you can see that the recovery is been equally as impressive. And in fact, when we look at manufacturing and service data globally, it's actually at high levels that we really haven't seen since before '08. And so that's signaling future GDP expansion globally.
One other thing I was going to note on this is it's kind of interesting the type of recession we went through. Not only was it the shortest in history, but it was a different type of recession in that normal recessions, manufacturing gets hit the hardest, while services, although they get hit, not quite as hard. Obviously here with these two arrows, you're seeing services in this recession hit by far much harder than manufacturing. But as you point out, both coming back strong. So what's this heat map showing us?
Basically, you want to see green. And so if we look back into 2020, 2019, we saw a lot of yellow, orange, and red, which was signaling weakness. And so if we look at the last two columns
yep.
of squares, essentially you're seeing a lot of green. That's signaling that we are seeing economic improvement, both manufacturing and services. You'll see a couple yellows, but surprisingly, I should say unsurprisingly, it's things like Brazil, where we definitely had a COVID surge. It's Japan, which is going through one right now. And so clearly, COVID still has an impact, and that's why there is a bit of a concern. But also the thing I would point out is we saw a surge in January, and that at that point didn't really impact the economic recovery.
So with everything that's happening in this resurgence in the consumer and all this manufacturing activity, we have seen inventories really tight. And it's expected that over the next couple of quarters, and I just heard recently it might even take 12 to 18 months for inventories to get rebuilt. And that's obviously put a constraint on some of the supply chains as well.
Yeah, so absolutely. The inventories were drawn down rapidly, and essentially with COVID restrictions, manufacturing did stop last summer at times. And then with the recovery in the economy in the US in the second half of last year, you saw demand come back strongly, but we still have constrained supply chains, that hit lumber prices. We've talked about chips used in car manufacturing, and certainly even I was reading today that the wildfires in Canada are not going to help the timber situation necessarily.
Now on the plus side, with all the activity that we've seen, although that's constrained inventory and supplies, GDP is improving and really bouncing off those lows of March, April of 2020. So we're back almost to the pre-pandemic GDP level, although we still have a ways to go really to see trend line from pre-pandemic levels.
But the good news is that the economy should expand strongly in the current third quarter as well as the fourth quarter. So we'll likely return to pre-pandemic levels by the end of the year, and then likely reach the trend line growth some point in 2022.
Excellent. Well, let's talk about the job market, because we know unemployment spiked during the pandemic. There was a global economic shutdown. Since then, a lot of people have gotten back to their jobs, but there still is a heightened level of unemployment above what I think the Federal Reserve and most of us would like to see. But what else are we seeing in this chart?
So here we're showing that essentially, again, because it was a very fast recession, we're seeing the job market come back very quickly. And so the June job data was stronger than expected. We did add 850,000 jobs. And the May reading, which had been a little bit weaker, was actually revised higher. But we're at a point right now where I think the gains in the job market are going to be a bit harder. You can't drive and look at fast food restaurants without seeing the signs of, we're paying $15, $16 an hour, and they're still not finding people.
Sure.
And so I do think that we'll see that unemployment rate tick down from 5.9% as we go through the year. Now, I think optimists are thinking that it could reach 4.5% by the end of the year. I'm not so sure about that, but I think we'll be moving in the right direction. But we are also, if you look at that blue line, that's wage inflation. Wage inflation is ticking up.
And that, when I think about inflation and concerns around inflation, it's really not price inflation that bothers me as much as wage inflation, because that tends to be very, very sticky.
Absolutely.
So let's talk about, on this next slide, the earnings rebound, because earnings are so important, especially as we get into the discussion around the markets, because really markets move off future expected earnings. So what are we seeing in the earnings realm?
We're going to see an improvement, and on this slide we're showing manufacturing new order activity, which is a leading indicator, and it actually correlates well with S&P 500 earnings historically. And so with that rise, and that's the orange line, we should see the blue line earnings follow.
So the rise there of the manufacturing is going to lead to a rise in corporate earnings. That's the theory.
That's the theory.
Perfect. So what we're seeing here then is projections.
Yeah, absolutely. One thing to note though, if we look at the green columns, those are years in which earnings are down relative to the prior year. So obviously 2020 with the pandemic, earnings were down. At that time, the viewpoint was that it would be hard to recover in 2021 to those levels, but expectations not only say that they'll reach that, but maybe actually exceed it a little bit. Now those might be a little rosy and we could see 2021 numbers come down just a bit, but so far in the first and second quarter, we're seeing those major double-digit increases in the pandemic hit areas that we're expecting. So even the airlines are posting good recoveries. Now they still have a ways to go to recover to pre-pandemic levels, but those are kind of the guideposts that you need. And so it does look like as we head into 2022 and 2023 that we will have fully recovered and we'll be basically making new earnings highs.
So with all of this good news and pretty much most of what we've shared today so far is good news, what do we think is going to happen on the inflation front? We briefly touched on it, but with all this activity, are we expected to see inflation?
We are, and in fact, we're seeing it. So June CPI rose 5.4%, May hit almost 5%. You can see that current numbers are running higher. And in fact, we haven't seen the headline CPI reach these levels since really before 08. But it's still this question, is it transitory or is it more secular or long-term? Now, the Wall Street Journal did a nice piece a couple weeks ago where it tried to break down the components into four buckets. The first bucket was, those industries that were hit by the pandemic. So think airfare, hotel prices, travel and leisure. We're seeing price increases of 20 to 25%, but remember, those were against really low levels last year, which also leads to the bigger picture on inflation. Is if you look at these numbers relative to last year, they're very high, but if you look at them relative to 2019 levels, they're actually more in that 3% range. But the other issue though is that we have industries that are supply constrained. So think about the whole chip shortage. That's leading to very high used car prices, modestly higher new car prices. But once they catch up, we'll probably see those prices come down. So that would help bring inflation down. But we could see in the travel and leisure area permanently higher wages because again, fast food, they're just not getting people back. They are raising wages and that might be the new normal. So in that case, that wouldn't necessarily help. And then kind of finally, we have those, that part of the economy, mainly the rental apartment area, where we're actually seeing very low increases this year. Now, historically, when we've seen an increase in house prices like we have, you typically see rents follow 12 to 18 months later. And so that is a little bit of a worry that with the tight housing and in general real estate market, that will hit rents at some point in the future.
So as we look at this chart, we see that, I guess I'll call it slight spike there at the very end that you made reference to. What about the long-term inflation expectations?
Yeah, so here the long-term expectation is in the blue squiggly line. So it's currently at 2.8%, which is still well within kind of the Fed's expectations. But as you mentioned, the real question is going to be wages, because if people expect inflation to go up and the expectations go up, they'll demand more wages. That gets put into union contracts, and then, you know, like in the late 70s, for example, they put COLA escalators in contracts. We'll probably see a Social Security increase. That is the concern. But so far, they're still in check.
So despite all the discussion about inflation, and I think it was probably even a heavier discussion earlier in the year, we've actually seen a recent dip in bond yields.
Yeah, absolutely. So at the end of the first quarter, the 10-year Treasury was at 1.75%. And then at the end of the second quarter, it actually had dipped to 1.5%. And then interestingly, since the end of the quarter, it's actually dipped a little bit further. It's this ebb and flow between the inflation side, which kind of brought things up, with the other side most recently about some concern about the Delta variant and what that would do to growth rates.
And we'll come back to these bond yields because that will correspond to our discussion on bond performance, which actually is a great transition into the markets. So as we think about the economy, we had a lot of positive things to say there. The economy is restarting from obviously hopefully a once in a lifetime shutdown. The markets have responded and continue to provide excellent performance, as we'll see here on this slide with equity market performance. For the quarter, everything doing quite well. Now, these may not be all that impressive unless you remind yourself these are literally quarterly numbers, not annualized. So on an annualized basis, these would hit kind of that territory that I refer to as ridiculous. Don't get me wrong, I like that territory, but you know, ridiculous territory. On a year-to-date basis, super strong. I mean, pretty much every single one of these numbers is well above historical averages. Now, that's not necessarily the case when we look at bonds. So the quarterly performance for bonds looks decent, and that has to do with that dip in yields. So that corresponds to increase in prices. But on a year-to-date basis, bonds, both US and global, are slightly negative. As we break down the equity markets between large cap and small cap, and between their style boxes, value versus growth, we're going to see clearly that for the second quarter, large cap growth came back into favor. However, if we look for the year, it's just the opposite. It's really that small cap value part of the market that's performed quite well for the full year. And we're going to get a little bit more, Jonathan, I think, into this discussion around growth versus value in the next couple of slides. So talk to us about how the sectors have been impacted pre-pandemic, or I guess this is really pre-vaccine versus post-vaccine.
Yeah, absolutely. So the interesting thing is when you sort industries and sectors by the date that Pfizer was approved, there's a clear trend in place. So if we look at the pre-pandemic area, so kind of the gray, early on, you'll see that energy, airlines, those areas that were most affected had negative performance, Whereas if you look down on the bottom, you'll see online retail, home improvement, infotech, groceries, those things that benefited actually had positive performance. But that flips. Once the Pfizer vaccine was approved, the market started to look to economic recovery. And so typically in downturns, those things that are down the most actually are the leaders coming out. And so that's where we're seeing energy, airlines, and retail doing very, very well.
Sure. Well, let's touch on the style returns during that time frame.
Right. So, big picture, value underperformed in the first half and growth outperformed in the first half. But again, that flipped. And so we saw value and small cap. And so you mentioned small cap value kind of leading the way in the second quarter. That's really what we've seen post approval of the Pfizer vaccine. Now, that's not to say that, growth actually had positive performance. So in the breakup, growth has kind of not done as well. But when you look at the pre-approval performance, it's actually done very, very well.
And how do we see the breakout on more of a regional basis?
So early on in the pandemic, China, because of its history of knowing how to deal with pandemics, was able to shut it down early. So we saw massive performance in China prior to the Pfizer approval. But post-approval, China's returns are positive, but actually lagging. So it is Europe that was badly affected early in the pandemic and had negative performance that has actually seen performance more in line with the US.
Sure. So to that point, we've seen solid international returns. China less so than everywhere else, but pretty much across the board, strong performance, really correlating probably to activity with COVID, with Latin America doing quite well here in the second quarter. And I think you had mentioned to me earlier that was, again, correlated to really the COVID instances. That first quarter was a pretty tough quarter there, so they're getting a little bit of a bounce.
Yeah, so we saw incidents in Brazil rise in the first quarter, and it has been coming down.
We already made reference to this surprise dip in interest rates, and that really helping boost bond returns. I guess the one thing that I was a little bit surprised at when looking at this chart is just how poorly U.S. Treasuries have done. I guess I shouldn't be terribly surprised because that still is related to interest rates, and even though rates have dipped, they're still higher than they were starting the year.
Yeah, absolutely. Although rates are actually a little bit down since the end of the quarter. So that yellow bar, which was Q2 returns, were probably actually a little bit higher.
Even better since this data was released.
Yeah, absolutely.
Yeah. Well, good. That was a nice summary of the market data. So we talked a bit about the economy. We talked a bit about what's happened in the markets. Let's touch on our outlook, both from an economic perspective and then transitioning into a market perspective. So as we put here, the U.S. economy, it's in recovery mode. Obviously helped by our vaccine rollout, probably the best rollout in the world, as it looks today anyway. But we're still very cautious with regards to whether there's going to be any potential shutdowns of parts of the economy due to this Delta variant. Let's hope not, but I guess we can't take that off the table completely. We already touched on inflation, Jonathan, talking about that likely to be an issue because of stimulus, pent-up demand, constrained supply chains, and whether it's really going to be transitory or whether it will be permanent. One thing we didn't touch on is the added unemployment benefits that will be rolling off the system over the next month or two. And I think that's going to be a big factor in whether it's transitory or permanent. And of course, fiscal monetary policy, it's likely to remain accommodative. We don't know though, are we going to get more fiscal stimulus or not? It looked pretty certain a couple weeks ago. Recent news over the last day or two, I'm not so sure. We do know the Federal Reserve is going to remain very accommodative, but at some point they're going to have to signal a reduction in their bond purchases and ultimately, heaven forbid, more normalization of interest rates. And we just don't know how the market's going to react to any of these items, and frankly, when these are even going to be announced. But the consumer is in an excellent position. And getting back to an earlier comment, the consumer really drives 2/3 of the economy. So that's an important thing to keep in mind. And what we're seeing here is just how good the consumer is.
Absolutely. So the government estimates that during the pandemic that there's $2.5 trillion of accumulated excess savings that was generated. And so what we saw is we saw savings rates really skyrocket. That's that blue line. And then during the last 10 years, we've actually seen debt go down. And so actually during the pandemic, people did pay down debt. And so again, yes, we have to deal with the potential risk of the Delta variant maybe delaying parts of the recovery if it becomes worse. But with this $2.5 trillion of this excess savings, consumers are in very good shape to drive the recovery when it can happen.
Yes. Yeah, there's the old saying on Wall Street, don't fight the Fed. I would add to that, don't discount the consumer, because the US consumer, we like to spend. Let's talk about the international economy. We do believe other countries are going to start seeing the same kind of economic recovery that we're seeing. It's just they're delayed. We were the fastest to have the vaccines rolled out. No matter how impatient some of us got in seeing the vaccines at our local pharmacies and such, it has happened relatively quickly, and the rest of the world is kind of slow to catch up. But it will be coming, and we're starting to see signs of that. Of course, there's going to be continued accommodation with fiscal and monetary policy across the country. It's not just happening in the US. And as I alluded to, they are likely to come back in more of a recovery mode with their business cycle, probably the second half of the year. And this is really speaking, Jonathan, I think, to that recovery that we've seen.
Yeah, so on the left side, if we look at that green line, that's retail and recreation mobility in Europe. And it was well below US levels during the winter. And it actually has surprisingly increased probably faster than some people expected, even because of the Delta, because that's been kind of an issue in the UK for a couple months. But nevertheless, even if that comes down a little bit, there is still that pent-up demand even in Europe. And if you look to the right, we're looking at the service industry confidence rates in the Eurozone, and those have spiked. So again, is it delayed? It's not derailed.
Sure.
If the Delta variant becomes an issue.
Well, and we already mentioned the US consumer and the excess savings that is occurring here. But what this is showing us really is that's a global phenomenon, that really savings rates have gone up pretty much across the world. Again, getting to the fact that consumers, which tend to drive a lot of the economic activity, they're in a position to drive that activity indeed. So let's talk about, Jonathan, our outlook in the equity markets. What are we expected to see there?
Well, we know that stock valuation has been high, and we've talked about that, but the broad-based earnings recovery we're seeing is likely supportive, and valuation will probably work itself out as earnings recover. But again, remember that the valuation reflects positive expectations, and that there is, again, this issue with the Delta variant that could cause the markets to be susceptible to a pullback. And then we talked about the fiscal issues. Well, the other side to fiscal stimulus would be potential tax increases
Sure.
that have been at least discussed at this point.
Sure.
But as we kind of work through the post-pandemic economic landscape, we'll likely see volatility increase. So volatility this year has been relatively low. And again, what are the issues that could cause that volatility? It's this whole issue, again, with the Delta, rising interest rates, the potential of inflation, the timing and magnitude of the Fed and how it communicates, and the fact that at some point, even if more fiscal stimulus is passed, it will wane at some point.
Sure.
And then, as we mentioned, growth valuation has remained stretched. Now, in the second quarter, it actually did a bit better than value, but value and international still likely are in early stages of recovery. But in general, the cyclical outlook does remain constructive.
And I really want to touch on the earnings, because earnings tend to drive markets. And we talked earlier, Jonathan, that earnings are looking very, very favorable in the U.S. Are we seeing the same thing internationally?
Well, we should. And so we showed the slide where the activity in Europe seems to be picking up. If that continues, we should see a pickup in earnings as a result as we go through the year into next year. And so if you look at EM in Europe in kind of the middle of the chart, you'll see that very strong earnings growth is expected. But what could be driving that is kind of that light blue number with the diamond. That's the percentage of cyclical sectors in those markets. They're higher than the US.
And how about the outlook for bonds? We've talked about interest rates going up and then recently coming back down, and the fact that bond returns are so dependent upon rates and spreads. What do we think going forward as it relates to bonds?
Well, again, because rates are still relatively low, and it's hard to go much lower. I mean, they could a little bit. So as a result, returns are likely to be on the low side. Now, this year, we're seeing slightly negative returns. Historically speaking, last 50 years, we just really haven't seen 2 years in a row of negative returns. So again, next year, we should likely see positive returns, but again, probably modest returns.
And that doesn't mean this year is going to be negative. Right now, year to date, I think they're slightly eking out some positive performance. But either way, it's not going to be all that impressive. Having said that, bonds are not the growth engine of a portfolio. And I really can't stress that enough. The way we utilize bonds anyway is not to provide that growth. It's really to provide the foundation, kind of the stability or the ballast of the portfolio. And we do believe that bonds still provide downside protection. But as you alluded to, who knows what's going to happen with the Federal Reserve, with their bond purchase program, interest rates, etc. We'll just have to kind of monitor that over the next couple of months. My guess is, Jonathan, Jackson Hole. That's a big date or big event, I guess, when the Fed gets together. That might be the event in which they start to announce some reduction in their bond purchasing program, because you just can't continue to buy $120 billion of bonds every month forever.
No, I agree. I did have a slide that didn't make it into the webinar today, which was showing the Fed balance sheet, and that has ballooned.
Everything else was so positive. I just didn't want to ruin the trend.
Right.
Well, and we'll talk about some SilverOak updates in 1 second, but before we transition off of the markets, I am always reminded when I think about and reflect on particularly what we discussed today, with everything being pretty positive coming out of today's discussion, that there is a lot of data, and you and I haven't even discussed this, although you know the fact, that in general, when GDP is really high, equity markets tend to perform worse. And when GDP is really low, equity markets tend to perform really well. Just kind of opposite of what you would think. And last year was a prime example, right? Terrible GDP last year. Yet the stock markets did phenomenal. Now, I'm not projecting that equity markets are going to lose all the ground that they've gained this year. That's not my point. My point, though, is even when economic data can be really, really positive, and it looks like it's going to be, and we are pretty constructive on the markets, history tells us not to get overconfident.
I would agree. And so as we go into next year, we can't necessarily expect equity returns like we've seen in the last couple of quarters.
Yes. So with that, let's transition to our SilverOak updates. And we've got some exciting things to talk about here. Oh, I'm sorry, I went a little too far ahead there. First, one of the most exciting things is actually the last bullet point on this slide. We are open for in-person meetings. It is so nice to be sitting down with clients face-to-face again. Not that we don't like doing Zoom, and in some cases, obviously, we're forced to because of just where people are located. But it's nice to be back in the office, and frankly, it's nice to have the SilverOak team transitioning back into the office as well. So it's great to be sitting here right next to you, Jonathan. I know we did it last quarter, but I can't stress how much I enjoy that. We do have a couple of upcoming white papers, one on moving. So if you're going to be moving households, there's a checklist. One on inflation, which is very timely, and a second behavioral finance white paper. As far as performance in our IQs positions, what did you want to say about that, Jonathan?
In general, we've seen very, very strong results, not only absolutely, but also on a relative basis. So our large cap funds have done very, very well. We've had several exceptional value funds, several exceptional growth funds. When we look at another large category, international, we've had several very exceptional funds, both on value and in growth. But we do have a couple funds that we are looking at more. The results were good, absolutely, but they are lagging a little bit on a relative basis. One is in international, and then the other one is in small cap.
Sure.
But when you think about the investments that we utilize, to have only two when we've had such a big increase in the equity fund performance, that's actually very good.
Yeah, that's quite successful. That's good news. Well, a couple other components of good news. We've added 2 new team members over the last couple of quarters. So I'd like to take the opportunity to thank them for joining the team and for the opportunity to work with them and look forward to all of the success they're going to have with SilverOak over the next many years, as well as the fact that we have 2 additional team members that we're expected to bring on by the end of the year. So our team continues to grow, and we're adding great members, and I just can't be excited enough to see that happen. And then the other thing is, just as an FYI, for those who do like to come into our office for meetings, in October/November, we don't have an exact date yet, but it's probably going to be one of the last weeks of October, we will be moving. We're moving to the building next door. So if you accidentally come to our existing office, it's a very short walk to our new office space. That's not happening quite yet, but in October/November it will be. We'll send out an announcement once we have exact dates for that. But because we're growing, Jonathan, we simply have run out of space here and need more office space and workstation space. So with that, for those of you who are interested in cryptocurrencies, I encourage you to stay connected. We're going to spend the next 10 minutes or so talking about cryptocurrencies. And before I get into the slides, I guess, Jonathan, I just want to throw out the fact that this was kind of a difficult topic to present, only because I know many people have very strong opinions one way or the other on cryptocurrencies. And it just so happens, at least for me, and I don't know, may be the case for you. The activity with regards to questions I get with cryptocurrency tends to correlate directly with the value of Bitcoin. And when Bitcoin is going up and high, I get tons of questions. When Bitcoin's going down and is lower, I don't hear anything.
So you're saying at 32,000, no one's asking you, but at 62,000?
That's pretty much what I'm saying.
I've seen the same.
That's pretty much.
Same experience.
So really what we're trying to do is just present some information on cryptocurrencies. I think it's very early in this whole process to be too confident one way or the other on how this is going to play itself out. But let's start with just the basics. So at a very basic level, share with us, Jonathan, what cryptocurrencies even are.
Well, they're digital currencies. They're based on a technology called blockchain, which is also being used in other industries, not just in terms of digital currencies, but it allows electronic peer-to-peer transactions where a bank or another intermediary isn't required. And as a result of it being digital, you can do it globally, 24/7, can be done relatively quickly with relatively low fees.
And in doing so, usually you're doing it, a lot of people for security purposes do it using a digital wallet, like maybe Coinbase. I think some people may have heard of Coinbase, which is just essentially a digital wallet where you would hold, let's say your Bitcoin or whatever you might want in cryptocurrency, or you could do it on your phone, computer, the cloud, etc. And as Jonathan, you alluded to, the last bullet point here is they operate without central banks. They're not backed by a government, so there's very light regulation in this area, at least currently. So give us a couple of examples.
So Bitcoin is the one I think a lot of people talk about. It is the largest, but there's also another one called Ethereum. It is the second largest after Bitcoin. It is a little bit different in its structure and its technology, but there are others. There's things called stable coins, which values are pegged to either fiat currency assets or another cryptocurrency, and that, from my understanding, is to try to make them a little bit more stable in terms of their volatility. And then altcoins. There's literally thousands, and we mentioned Dogecoin, but again, there are a ton of others out there.
And Dogecoin people might have heard of because of the Saturday Night Live bit with Elon Musk. But the point being, everybody's heard of Bitcoin, or most people anyway, but there's many others out there. So you have to know that. So Bitcoin, since that is the biggest, we'll focus a little bit on that. It was created not that long ago, in 2008, as Jonathan alluded to. It's the largest of the cryptocurrencies. Transactions have no counterparty risk due to kind of that blockchain technology that he referenced. It's easily divisible because it's digital. You can pretty much slice and dice it however you want, but there is a limited supply. When they were created, they kind of limited at 21 million coins, and demand continues to grow while that supply is kind of approaching that 21 million limit. There are estimated anyway to be 30 to 100 million holders in the US of Bitcoin, which is pretty astonishing. But I think even more so, it's used overseas, particularly in emerging markets. So explain to us, why would that be the case?
Yeah, so again, because it's used in other countries, there are a lot more holders than even in the US. But one of the reasons it's used in emerging markets and less developed countries is that there's a lot of instability. You see countries with higher levels of inflation.
A lot of instability in these other countries.
In the other countries,
yeah.
Right. And you also see instability within their currencies, with the fiat money. So Bitcoin has been perceived, at least, as a more secure method of payment and store of value than the local currency in these countries. And as well, with instability, verifying identification is a bit harder. And so with Bitcoin being totally secure, you don't have that issue.
Sure. And some people consider it to be potentially a lower correlated asset to traditional financial assets, maybe more similar to something like gold or art or collectibles. And frankly, for that matter, I think we mentioned a little later, maybe potentially more of an inflation hedge than other assets. But it is highly volatile. And you had mentioned trading around 32, 33,000 now, had been as high as 62 or some thousand just a couple of months ago. So this is a relatively volatile currency asset, whatever you want to reference it as.
Yeah, absolutely.
Now, to that point, what are cryptocurrencies not? Well, they're not traditional currencies, right? I mean, they are not widely accepted. You can't go down to your hardware store and just use Bitcoin. Not necessarily a unit of account, maybe not necessarily a store of value just because of the volatility that comes with them. And they're not backed by any central bank, although there are several countries and central banks that are looking at their own version of a cryptocurrency, including the US, a digital dollar. As a matter of fact, I listened to Jerome Powell's testimony to Congress last week. He does a semi-annual testimony to both branches of Congress. And they had made reference, questioned him on the US's progress, the Fed's progress in developing a digital dollar. And it sounds like they're making substantial progress and are almost to the phase of getting public input, where then they'll take that input, apply it accordingly, and then release the information that they're going to have on a digital dollar, which really could be a game changer. The one thing I will say, as the cryptocurrencies are related, I am 100% convinced we are going to some kind of digital currency, and that the old currency system is a way of the past. I don't know how quickly we'll get there, but I'm 100% convinced. The question is, will it be XYZ, ABC, or will it be a government like the US with a digital dollar that's driving that? What cryptocurrencies are not? Well, just like we said they're not currencies, they're not really commodities either. It's not like a physical raw commodity like timber you had mentioned. It's not a precious metal like gold. It's not a stock, bond, or a traditional real estate investment, right? They don't pay dividends, they don't pay interest, there's no cash flow from rents, there's no common valuation method that's accepted amongst them. They have much higher volatility. Maybe correlation is lower, we'll see. And they're certainly harder to hold as an investment. It's not like you can just easily go out and buy a stock the same way you might be able to go out and buy a Bitcoin. You have to open a digital wallet, at least to do it securely, etc.
Yeah, as of right now, at least, Schwab, Fidelity, and the other major brokerages don't really allow you to hold it within your brokerage.
But that could be changing. I mean, certainly this environment is evolving. So what are they? Well, I would say most optimistically, a future means to widely exchange goods and services. And I mean widely, where you could go to the hardware store, you could go to the grocery store. But if that is the case, then it brings me back to, well, which one will be the one, right? Does anyone remember AOL or Yahoo?
Or even I mentioned Netscape and Mark Andreessen.
Exactly. I mean, who knows? Maybe it is Bitcoin or Ethereum, or, I mean, who knows? But again, that's probably the most optimistic, is it's a future means to widely exchange goods and services. Potentially it's a diversifier, right? I mean, theoretically, people believe it to be a lower correlated asset to traditional assets, maybe even a possible inflation hedge. Although I'll just make note that in today's Wall Street Journal, there's an article about whether this is truly an inflation hedge or not. I would say certainly it's a more speculative investment. With high risk, though, is the potential for high return. And hey, there's a lot of speculative investments out there that people enjoy going in and out of to try and get that high reward for the risk they're taking. So what are those risks?
Well, again, they're extremely volatile, and we haven't talked about this before, but it certainly seems like the fact that we've had China crack down on mining and just in general Bitcoin. Elon Musk has added to the volatility by accepting it and then not accepting it. Another issue is that some of the cryptocurrencies do price on a centralized exchange, some do not, so that's not uniform. We've mentioned the potential competition from central bank-backed digital currencies, kind of uncertain regulatory environment. So even in the US, all the different federal agencies view it and regulate it a bit differently. And as I mentioned, China is right now cracking down. While Bitcoin itself is secure, we have seen some exchanges hacked. And then the fact that you can use private keys to give somebody access to your blockchain, the mismanagement of those keys could cause security risks.
And of course, there's lots of criticisms as well, right? Criticisms around maybe illegal activity occurring with these. I think you mentioned Elon Musk. They had accepted it and then they stopped accepting it. I think because of bullet point number 2, the mining, it's very, very energy intensive.
Yeah, now on the other side, though, proponents of cryptocurrencies will argue that because it does actually fulfill a utility, that they have a right to use energy to do it, and that, you know, like other industries, they will be becoming more carbon neutral as well.
Okay. Maybe, maybe not. We'll see. The one that I really want to focus on here is the taxation. I mean, for these, in my opinion, to be adopted widely, there has to be something occurring on the tax side, at least in the US. Because the way it currently works, as a cryptocurrency, every time you use that currency as an exchange, a means for an exchange, or you sell it, you have to report that as a transaction that is reported to the IRS on your tax return, either as a gain or a loss, which means that every time you buy, you have to keep track of your basis. I just can't imagine ever having this as a widely used means of exchange if I've got to keep track of every time I purchase one of these cryptocurrencies, and then I go down to the hardware store and I actually use it to buy something, whether there was a gain or loss on the currency when I used it as a transaction to buy, you know, paint or, you know, paintbrush or whatever it might be. I just think that is very, very unlikely unless the tax structure changes, which, by the way, if you are using these, remember every one of those transactions currently has to be reported on your tax return. So what are the opportunities? Well, I mean, certainly it could be a store of wealth, or at least could get to a point where there's more stability for it to become a store of wealth. In certain emerging markets, maybe it is. I mean, if you're in Venezuela and inflation's, you know, 1,000%, maybe you don't care that it fluctuates a lot because it's more of a store of value than your local currency. But I think, again, to be widely held as a store of value, there needs to be a little bit more stability on that. It certainly could be an alternative asset class, like we mentioned, similar to gold or art or music or things of that nature. And there's no question, Jonathan, and I guess you could disagree if you'd like, but I think we're on the same page here. The blockchain technology underlying cryptocurrencies is here to stay, and it's just going to continue to develop over the next couple of years and decades. So the real question I think people are asking as we close out today's discussion is, should I invest in it? Well, I'll first start with, it may not be prudent for everyone. I mean, that kind of volatility just is not made for everyone to tolerate. So you have to understand the risk. And you would put here, play your own game, right?
Which is, you have to think about what your objectives are and invest accordingly. You can't just think of it as a hot stock tip and kind of drop everything just to do it.
Well, and if you do choose to invest in it, do no more than you're willing to lose, right? This thing could take off, but it could bust. Install limits, 1% of your portfolio or 2% or whatever the number is, but have some guidelines and some process, and certainly treat it as a learning experience. Prioritize your other financial goals. We have clients all the time. They have their sandbox account, right? The sandbox this is money set aside. If it goes to zero, you're not going to have to change your lifestyle. You're not going to be upset. You're just going to say, hey, that was a learning experience. So be it. I would put cryptocurrency, Bitcoin, in kind of that sandbox category. It's money that if you want to play with, great, but it's not going to make a major or have a major impact if something goes south. If all of a sudden the US comes out with a digital dollar and all these other cryptocurrencies really kind of flounder as a result. So with that, certainly reach out to your SilverOak advisor if you have questions on this. As Jonathan alluded to, these aren't available in standard brokerage platforms. Your Schwabs, your Fidelities of the world, at least not yet. I know new product is coming out. New ETFs are trying to be formed to give access to maybe even a basket of cryptocurrencies. As those things occur, we will keep you informed and give you updates on the happenings in this realm of the investment world. In the meantime, again, I encourage you to reach out to your SilverOak advisor with questions. If you have topics for the next webinar, I encourage you to suggest the topics for our future webinars. Otherwise, Jonathan and I both wish you have a very, very good end of the summer as we roll through the July and August months, and we'll be in touch again next quarter. So thank you and have a good afternoon.